Hey, thanks for tuning in. This is a weekend review for the week ending 5/16/2021. We're taking a look at the S&P 500, which has been on quite a tear since the March low. But really going back to this September 2nd, you can see that there's just been heavy distribution. Even though price has gone higher, they're definitely selling. There's also a bearish divergence on the daily chart going back to that point as well. This leads me to believe we're probably in something like a wave 5 that started back here at the end of this zigzag. Your 1, 2. Looks something like that. Put in the 1,618, the 2, the 3,268, right? So looks like it topped maybe right here. Put in an ABC, right? So you're 1, 2, 3, 4. We could be in the 5 here that's putting in some mega top. This is definitely possible, right? I don't want to scream top, but I do want to point out that, it is a bit stretched. You certainly come up to 433 and that be the wave 3 of 3 top. And I certainly have counted this wrong. So don't get too attached to the macro count. Look at it more of just a repeating of the same pattern over and over and over again. This 5 wave up and this ABC down. Certainly looks like this 5 wave up completed a little expanding flat with bullish divergence. So you've broken this, at least this bearish divergence. And these bearish divergences don't mean too much other than prices correcting momentum out in time. They can go on a lot longer than most people think. That being said, I like to come into this week with the idea of we're just going to trade the gaps, right? We still have a gap down here that's unfilled, right? We've got a gap down here that's unfilled. We've got a gap down here, gap up here, gap right here. It's just gap city. Last week, filling 406 felt like hell because to start the week, you basically dropped 5% on a major index, and if you were holding any stocks, growth got hammered. This week, the stocks that did the best, it's the same theme. For pretty much since the top in February, the stocks that have been outperforming have been finance and energy. The stocks that have been lagging have been IWM, growth, and tech, SMH. So we'll take a look here and we'll zoom into, we'll take a look at the weekly just to give you some more context, right? This is starting to expand out, right? This has me a bit concerned, but there is no bearish divergence in momentum. We're still printing higher highs. So that is very bullish. And this goes back a long time, right? You gotta go back to 2009. So that's really what could be at play here. Is this just macro count? 1, 2, 3, 4, 5, and then a big zigzag correction here to start wave 3. That's definitely possible. And what you're going to get here is some big correction, whether it's an ABC down or an impulse down. We'll have to wait and see. But any pullback, really into 340 would be a strong buy. It's hard for me to say you should be heavy long at this point or buying heavy long here from a weekly or monthly standpoint. But if you're an active trader, dips into the 10 on the weekly have been bought going back to November. There's no reason to be shorting yet. There's no reason to abort your longs yet. The trend remains up. And this can continue a lot longer than most people think. And if we are in some macro wave 3 of wave 5 on some super cycle trend, then it'll play out. But it'll start with divergences, and we don't have those yet. That being said, one ETF does, right? This is exactly what I'm talking about. So, if the Qs don't fix this, then there's a big problem. Likely to head all the way back down here to -1. She's still at 3. That could bring into play an expanded flat. So this little 5-wave move here that ended in February is putting in an ABC, and then she can participate again. That's also possible. But she's still very, very stretched from the 200, very stretched from the 40. Still full-blown uptrend. Bears cannot close below the 20. The 20 continues to be demand. It's been touched now since September, which is when there was that larger correction on SPY, and it's when Amazon has been going sideways, Nvidia has been going sideways, all the big tech names, all the darlings of the last 8 years have been going sideways since August. It's also when the divergence began. And if you look at the volume going back to February of 2020, all the heavy volume bars are selling bars. They're red. Not sounding the alarm yet. Technically bullish above this low, this 297.55 low. As long as you're above 297.55, even break below it for a day and then close back above it on the weekly, this could be a flat. So it's definitely an ascending channel, and these channels can go on a lot longer than you think. Just zoom out. That's all tech does, is go straight up. The question is, are we going to get some big period of sideways performance again, like we had here? From a balance area standpoint, this is how I love to play these. Just let the market symmetry play out, right? So all of those buyers are in the money. And just from a symmetry standpoint, this could go to $729 before it pulls back. So you're not going to get me betting bear on tech. Although you do have this divergence, you now have a bullish divergence forming. The low from March and the low from May. If the bulls come together and start marching higher from here, they could break out, and that would form a bullish divergence. It's really tough to call at this point. This is the count that I'm watching this week. It does look like 1, 2, 3, 4, 5-wave move up from the March 5th low. A zigzag lower. Right? How to tell when this had ended? You had an inside bar with a doji. You do have a bullish divergence still possible. And then the next day they gap and go and recapture the 5 and the 100. So to me, bullish until proven otherwise. I will be buying dips into 319, dips into 315 to fill this gap down here would be a gift. If you're patient enough, it could be given this week. Now I will bring up one important piece of information, the structure. So this correction obviously started on the 19th, that outside reversal candle, and then within 3 days they gave up the 10, the 20, and the 5. So by the 3rd, it was pretty obvious that the correction had begun, especially with the gap and go down. At this point, you put in an ABC up, zigzag lower, right? It starts to get a bit dicey below 300 and this POC. Quite frankly, this point of control has been a great entry for bulls. So as I've mentioned, the onus is on the bears. If the bears are really here, if this is some big divergence, the Qs are done going up, and that weekly bearish divergence plays out, what you'll likely see is them come up, get rejected at 330, 332, 333, this declining 20. That'll be a nice short entry, and you'll head lower. But you notice here the structure, May 14th, so Friday, they pierced this low. So if this was like a 1, 2, 3, 4, 5, or some 5-wave move lower on the daily within a zigzag on the weekly, or some larger weekly, monthly correction, then they would not have pierced the 326.21 low. They would have stayed below that, right? Demand would have been absent, and it would not have been able to drive price this high, but it did. So I think that's a clue. They also tagged the 10, and they did not find a lot of sellers anymore. So I think you're going to have a lot of people waiting for this gap this week. It may not fill. In fact, if the correction is done, the 100 and the 5 will be your only entries to start the week. Let's take a look at XLF, which has been the leader. It is hard for me to say hop on board at these prices, right? We have this divergence going back to November. Price is a bit extended from the 200. However, this is a bull configuration. There's no other way to look at it. The structure from an Elliott wave standpoint, has me looking at either 5-wave move up from the 2009 low that ended in January 2018, an ABC lower. This is your wave 2. Now we're in some wave 1 of wave 3, or this is a 5-wave count where that was wave 3 in 2018. ABC lower, just an expanded ABC into the 200 on the monthly. A beautiful, beautiful setup. And now this is your wave 5, which will be similar to wave 1, right? 1 year, 2 months. So that could be coming to an end here. And you do have a bearish divergence setting up here on the monthly if they do not break this high. So it's really hard to tell, exactly what the count is on a lot of these names. But if you look at the weekly, you're stretched, right? The buy was back here when no one wanted her, when the momentum indicator was back near the 0 line. Momentum indicator is at 7.6. Now blue is still above red and it's sloping up. So the trend is very strong. This is not over. Nothing has ended here. However, I am a mean reversion buyer. I'm looking for a correction into the 20 or the 40 on the weekly. Well, the 20 is at $33, and we closed the week at 38 with the doji, right at the 618 extension. So that's where the sellers showed up this week. It's not for me. I was trading it back here. We got rid of some here, and we never bought back because we have not seen an ABC correction since. So we certainly sold too soon and abandoned the trade too soon. But lesson learned. It was this little gap scenario here that really got us confused. XLE, far, far weaker than XLF. But XLE is only 3% of SPY, so it doesn't matter. And the thing about this here that's a bit concerning is the 200 and this trend line. Now, this is an ascending channel. Everything's fine. These dips are going to be bought. But what I would love to see is, ABC down, something, a B up, and then another C down. I'd love to see more time, more flagging here to let these moving averages catch up. But as you see with the momentum, the bulls are back in charge, right? This could go up to the 200, come all the way up, fill these gaps, hit the 618, do a whole bunch of stuff here, satisfy the wave 3 extension, and then pull back. So if you're going to be short energy, wait for signs and signals that it's done. We don't have any signs or signals it's done. We have a cup and handle here. There's another cup and handle, right? More bullish momentum. Now there's a bearish divergence, just like in XLF, but that one in XLF played out for another month or two. So I'm long energy. I'm long Exxon. I'm going to continue to look for selling opportunities as we continue to set new highs and buy the dips into the 10 and 20 on the weekly. Let's take a look at some individual stocks. I like Penn a lot. Hasn't completed the 50% retrace here. Got very, very close though. Very, very close. Yeah, didn't do it after hours either. Has put in this sign of a reversal, but we don't have the volume yet. And because we don't have the volume yet and we're still in a descending channel, I put on a very small size position on May 12th. I waited for this reversal candle, capture of the 200, the day 2 buy, and then as long as you don't close below day 1 low, you remain in the trade. Even though it came very close on May 13th, I remained in the trade because we did not close below the 74.26 level. On Friday, they recaptured EMA 5, which is the first step towards repairing these charts. It's going to be a theme across a lot of the individual names. As you can tell, some of these growth names have just been slaughtered since the March 15th high or the February 12th high, depending on how you look at it, or what name we're watching. Down almost 50% in a month, in 2 months. But this was a huge name. It's definitely a name that I think has a lot of potential. The bearish divergence was very obvious. Now we're back down here looking for that bullish divergence. I do think that the fibs are the guide. I do think the 40 and the 50 on the weekly is a general area to look for this bleeding to take a breather. At minimum, we're looking for something like this. Best case scenario, we're going to get a new impulse from here and set a new high and then correct again. So either way, it's going to be a large correction in time. This is going to be range bound. So for this particular trade, we're looking to get rid of a good portion of this position when you get back up to $100 or so. And the fibs are going to be the guide. 89.19 is the first target. Art K, certainly something to talk about. Everyone is talking about Art K, and it's not positive. So I get attracted to others' trash. I don't know why, but I do. In this particular instance, you could see this top here, this divergence in price and momentum. That was your clue. Smart money was selling. All of this strength was sold. This triangle played out perfectly, and then another impulse lower, and then now the volume starts coming in as you hit this first fib extension. So the way I look at these, whether you want to draw it like that, you want to draw it like that, it doesn't really matter. It's telling you the same thing. If this $97, $95, $99 range area, right, from back here, if all of this starts to fall, then this becomes the target. So for now, the risk reward looks great. If your risk is about 3% from where we were on Friday at open, for a potential reward of at least coming back to the POC of 18%, it's about a 6-to-1. At minimum, come back up and test the triangle again from a weekly channel or a weekly breakdown back test. for a 12% gain, or 4 to 1. So I do like ARK-K. I did buy right around 100. I will look to add more if any weakness is given. This gap fill would interest me. Even extreme weakness to start like Monday or Tuesday down here at 94. That would be interesting too. I do have a very tight leash with that ad, and that that $95, something like that, right? But for now, on new ads, the stop was the reversal candle, right? So the low of that candle, 98.89. That continues to be the stop. Yeah, so has my interest this week as well. The way to play ARK-K from a leverage standpoint is PLTR. Charts are identical. Also had the reversal candle outside reversal, bullish above 1705. I think everyone was waiting for this gap. That's why it didn't happen. My alert did not go off, so I did not buy this. I decided to play ARK-K instead. You're starting to get that bullish divergence, which is what you like to see, just like you had the bearish divergence there with the two highs. There's a lot of volume here, which you can see in the volume shelf in the pocket, 24 bucks. I fully expect to go back and test that level. The question is what happens after that. So if you bought down here, or if you get any weakness into this gap or back to 1705, you're certainly looking like 30 to 40% gains. From Friday's open, it was a roughly 12 to 14% downside for 30% up. So not the best, not the worst. But if you're aggressive, now she's above the 5, right? She challenged the 10. So if she can hold the 5, the bulls have something to build on, and aggressive bulls will be adding at the 5 this week. On Monday with a tight stop being Friday's lows. Take a look at the pot stocks. These are very interesting to me. I find it hard to believe that something like a CGC is going to go much lower than where she is right now. The wave 2 requirement of resetting to the 0 line has been met. Sitting at this uptrend, sitting at the POC, going back to when she joined the New York Stock Exchange, May of 2018. So this is where they have been accumulating, right? All the big buys. That's what this orange line is. That's the POC, the point of control. That's where they want to keep price, right? There's a POC up here at around 46, and then there's a POC down here around 20 to 21, 18, depending on what time frame you use. They love to go between the two and just keep price range bound. If you look at when this kind of started, it was back here on this huge candle. Right? And what did we come back and test? This high is 21.55. What's this low? 21.73. So if next week we come back and fill the gap on the daily chart, finally fill the gap on the daily chart right here from the 5th when Biden, that whole thing happened, finally fill that gap, I think you've got a confluence of support back to where all these buyers were on the 18th of 2019, right? This was obviously, resistance, break above, never come back to back test until now. What was resistance is now support. Declining volume the whole way. The structure is beautiful with an ABC zigzag, right? The sellers are just in complete control, but they're running out of ammo. And if you look at it from, you lost the 20 on the 29th of March at $32, and you sliced right through the 40, right through the 100 without a bounce at all. You got to think that at some point here, either We're going to close back below the $20 range, find acceptance below this area, and head all the way back down to 9. Or they're going to retrace some of this down move. At this point, you have a 61% down move in 3 months. And no retrace, right? So even that retrace there does not satisfy even as a 38% retrace. So from an Elliott wave standpoint, right, even if this is now a downtrend and this is the end of an impulse wave, you would look for a wave 2 retrace that would be very, very steep. That's not how I'm counting this. I'm counting this 1, 2, 3, 4, 5, ABC down, and now we're looking for wave 1 of wave 3 to start. This aligns with the fundamentals of the United States moving towards federal legalization. But either way, once we do find a bottom, if the bottom's at 20, if the bottom's at 18, as you can see here, since there's been no retrace to date, you would anticipate a 50% retrace at minimum, but more likely the retrace would come all the way back up to $41.81 to $47. So if you look at the risk reward from where we closed on Friday, your downside down to $18, which is this low here, $18.37. If your downside from Friday's close is another 20%, your upside about 100%. You got about a 5-to-1 from Friday's close. I prefer, since I exited this trade back here, let's just wait for her to prove it. I did exit it on this day here, the 10th. I did buy some back at $22 after this gap fill, $21.74 gap fill. My alert went off. I market bought back, but I still am underweight. I would love to get an entry down here at $20. This gap fill right here at $21.19 would be very juicy to start the week. As you can see, though, just still straight downtrend below all the moving averages. Can't recapture the 5. Until she can recapture the 5, there's no reason to be aggressive. And the last one we'll take a look at is the MJ ETF for the same one. If you lose this level right here, 1952, it's all over. So for those interested in trading the MJ sector, she broke below and recaptured into Friday close. That's very bullish. She is setting up a bullish momentum divergence, but there's a lot of work to do to repair this chart. So for the MJ bulls, no need to get aggressive. For the energy bulls, I'd be looking to lighten up. Finance bulls, I'd be lightening up into this strength. We have to take a look at gold real quick. Gold's still breaking out. I do like GDX quite a bit. This is 2 weekly closes above the 40. Breaking out of this flag from the 20 low, it could be go time, but there's a lot of concerns. There is a TD9 sell on the weekly. There is momentum divergence still in play here on the daily. This is a leading diagonal, 1, 2, 3, 4, and we are in 1, 2, 3, 4, 5 of 5. As she approaches this gap fill, I would be very cautious not buying gold, right? I would wait for her to flag and prove that this POC is now in control by the buyers. If the buyers can maintain this point of control, then you're going to see $45 in the coming months. And remember, the risk of every wave 2 is an 85% retrace of wave 1. At this point, it's very obvious this is our wave 1 invalidation, 3064. And there are gaps on the chart down here, down here, down here, right? So there's a lot of Swiss cheese here, and this is a leading diagonal. So I'm not rushing in to buy gold at $39 this week, waiting for a pullback. All right, it's a bit long. We're at 30 minutes. Don't like to go that long, but thanks for tuning in. If you liked what you saw, like, comment, or subscribe on the video. Check us out on Twitter, and we'll catch you in the next video.